Hello, thank you for joining me for February 2025 market update and outlook. And it's looking like it's going to be a rocky February. Now, we'll talk about that as we get into the different topics because we're going to talk about tariffs, which is the hot topic of the day. And then we'll also talk about what happened in January, what that could mean for the rest of the year, and what you might need to be focusing on right now. So, the hot topic this morning, and I'm recording this on Monday morning, February the 3rd, is tariffs. Tariffs are being implemented. They were announced on the campaign trail, they're now being implemented. And when we look at where we are importing goods, the top five are the European Union, Mexico, China, Canada, and Japan. Tariffs are being considered against the European Union and have already been announced: 25% for Mexico, 25% for Canada, 10% for China. Now, there's some negotiation going on this morning, and the tariffs against Mexico are being postponed with some concessions on the drug war. So we'll see how this plays out. But right now, I think, we want to take a step back and say, well, what is a tariff? And that is a government-imposed tax on goods that are imported. We've had tariffs over the years. We've had some times where we've had a lot of tariffs. The first tariff was implemented in 1789 when President George Washington imposed a 5% flat tariff on all imports, trying to equalize some imbalances between the U.S. and Britain. We've had years where the tariffs really covered our cash flow need. We were a much younger country then, but that was before the income tax was implemented. As recent as President Trump's first presidency, he implemented some tariffs on China. He suspended some on Mexico. President Biden pretty much left those things in place. And we're now here, President Trump's second term as president, and he is implementing tariffs. Now, the reasons for the tariffs are many, but, they're often used for the reasons that Treasury Secretary Scott Bessent pointed out during his confirmation hearing. Number one, to bring manufacturing back to the U.S. If it costs more to import goods and it brings that price in line with what it costs to produce those goods in the U.S., it could encourage some manufacturing to come back to the U.S. Secondarily, to raise tax revenue. Now, President Trump is wanting to raise tax revenue so that he can extend Tax Cuts and Jobs Act. That was passed in his first term in 2017. It expires at the end of this year if it's not extended. And so having some other sources of revenue could help to get that extended. At least that's his thinking. And last but not least, using the tariffs as a lever in negotiations, which is what we're seeing play out this morning with this back and forth between the U.S. and Mexico. Using that as a lever to get some concessions in some areas that the U.S. wants some concessions in. But the big question is, how will the tariffs impact you in your portfolio? Well, you could pay a higher price for goods going forward, because if it costs more to import, then that's going to mean that it costs more to produce the good, and that's going to mean that that gets passed on to us as the end consumer. Companies are in business to make a profit. And so that gets passed on to us. It could also mean slower economic growth. It could reduce some of the selections of goods and services, because there may be things that it doesn't make sense to import, but that it also doesn't make sense to produce here in the U.S. It could put pressure on the U.S. dollar, and that is occurring. That has occurred over the last few days as the market and the global market is becoming more focused on the tariffs. And then it could reduce company earnings over time. If goods cost more, they sell less, or they lose out to other competitors within the U.S., then it could reduce some of those company earnings, which in turn would reduce the growth of those companies, because earnings drives company growth. But the bigger question, I think, right now is, are these tariffs going to cause a recession in 2025? We've been so focused on when is our next recession. We had COVID, and then we came out of that, and we've had some expectation that, with the inverted yield curve, that we might end up with a recession. We skated out of that, had a soft landing. Are the recessions going to cause the tariffs going to cause a recession? And I would say, no, the tariffs are not going to cause a recession. We still have very strong growth here in the US. We still have a lot of good numbers in the underlying data. And the tariffs may shift where goods are being purchased from. It may shift which sectors are doing better than other sectors. There may be some shifts, but it's not necessarily going to create a recession. We still will have money to spend. We just may not spend it in the same areas or on the same things that we had spent it on if the tariffs weren't in place. And so that said, I want to look back at what happened in January. And at the end of January, I always like to look at this January barometer, which is a very interesting phenomenon, not really fully explained. And it's based on data from 1950 to current. And there's two parts to it. The first part says, if the market is up for the first 5 days, so we're up for the first 5 days, then 83% of the time, we're also up at the end of the year. And in the first 5 days of this year, the S&P 500 was up 0.62%. The second part of this says that if the market is up for the full month of January, then 88% of the time, we're up at the end of the year. And the S&P 500 was up 2.7% in January. So that could mean that we are going to be up at the end of the year. This is not 100%. There's still that 12% where the market is up in January and it's down for the year. So it's not a guarantee, but it does imply that we have a very strong possibility of being up for the year. And that combined with the underlying data that I'm seeing, all of the numbers that I'm watching, makes me believe that we're going to be up at the end of the year, just with more volatility between now and then than we've had in recent past, as we work through the shifts in all of the things going on. Now, globally, we want to take a look at how did the rest of the world compare to the U.S. Now, it's interesting to note that here in the U.S., all sectors were up except tech. And partly we were hit by this new news that came out of China that they have an AI contender called DeepSeek that is on par with ChatGPT and some of the other AI solutions that we have here in the US. And the idea that contender, the DeepSeek AI, is being run on cheaper technology. And if it's being run on cheaper technology, then maybe some of the tech that is being created that is more expensive won't be needed. Maybe some of the other technology that is being created, whether that's hardware or software, maybe some of that is not going to be the top of the line if we have competition that is much closer to us than we realized. And so here in the US, we obviously have to continue to step up our game and stay on our toes and, put good effort into making the most efficient and effective solutions in that area. And I do think that area continues to drive efficiency in the markets going forward and in our economy going forward. Because tech was hit as it was, and because Europe doesn't have the same exposure to tech as we have here in the US, the European markets outperformed the US. Outside of Europe, the emerging markets were all over the place. There were some that were up a lot. There were some that were not up very much. There were some that were down. And so that was a real mixed bag. But if we take a minute and look at the global indexes around the globe, what we see is nearly every index was up. But if we look at Europe, you see that most of those, all but one, were up more than twice as much as the S&P 500. And that's because of the reduced exposure to tech. Tech also had an impact on which of our factors here in the US were up. Our growth factor, which is very much driven by those tech companies, was down for the month. But we still had very strong performance in momentum and very good performance in value as well. In the commodities areas, gold, silver, and natural gas were significant outperformers for the month. A lot of that is tied to all of this that we're talking about, all of the story that's happening, whether that's we're going to need energy for this AI and all the data centers, or we might need some safe havens for to avoid some of this volatility. So it caused these areas to be up for the month as well. And then in fixed income, we see that nearly every area again was up for the month. And that's partly because the Fed is beginning to back off a bit on its needing to raise rates. Now, I've been talking about the fact that I think they'll keep rates higher longer. I don't know that all the market is expecting that. And that gets priced in. When it does get priced in, that has some impact on these returns. But the tariffs just add to the fact that we will likely see a longer period of higher rates. So higher rates for longer. And that's something that we want to watch and pay attention to, because that impacts all other aspects of the market, whether it's how we discount our stocks, the earnings from companies to get the stock price, or the impact of higher rates on corporate balance sheets. But when it comes to forecasting and what you need to think about, the only market prediction that really matters is that you are following a consistent, disciplined investing process that's going to lead you to your best outcomes for your unique situation. You need to stay focused on your own long-term plan. And so with that, make sure that you have the right amount of risk. Take a look at that for this year. Think about your short-term, your mid-term, your long-term buckets. Make sure you have the right amount of money, especially in the short term. Don't forget about the asset location. It's a good time to be thinking about, do you have your assets in the right accounts? Are they in the right taxable account or tax-free account or tax-deferred account, so that you get to keep more of what you're receiving in growth? And then think about your 2025 tax plan. What is your tax budget? What is that tax budget, and how much room do you have for any shifts? You may have some opportunity to use some of that tax budget in the next month or 2 months. So be aware of that. Stay focused on your long term. And I wish you the very best investing so that you have the retirement that you need and that you want and that you deserve. So wishing you to be on your best path in your retirement.